Well, the growth rate in the FNB House Price Index for September stalled on 5.6%, unchanged from the revised August figure. And joining us in studio to discuss this is John Loos. He's property market strategist at FNB. Thanks so much, John, for joining us today. Well, as I say there, a stalling coming through. Take us through what's actually emerged here.
Well, yeah, we had some mild acceleration in house prices and house price year-on-year growth earlier in this year. I think that was the lagged impact coming through of a little demand surge in the summer quarters as a result of 250 basis point rate cuts late last year. And there was the effects of QE2 and a bit better economic period during the summer. That has passed on now. The effects of those rate cuts have passed by. There haven't been any further ones this year. And of course, we know the global economy and the local economy have both been slowing in terms of growth in the second quarter. Putting a little bit more pressure on disposable income growth. And so not surprising now we see what almost looks like a mini peak in year-on-year price growth. If you look at it month on month and we seasonally adjust it, we do this little statistical adjustment. We've had the first month in September of negative growth or decline, minus 0.27, after positive growth since the beginning of the year. So it does seem to be slowing, but no real surprise there, given that there is a distinct lack of stimulus in our economy at the moment.
What would the stimulus be? Do we just have to wait it out for these economic factors that you've outlined to change, and more so for the global economic landscape to shift?
Well, I think for house prices to grow in the current times, we need some sort of a clear stimulus because it's an unbalanced market. It has been since 2008. If we look at our Valuers Market Strength Index, they're putting it at below 50, which means that they rate supply as better than demand. And they have so consistently for a couple of years now, which means that you should probably get at least real house price decline. We have had that for the most part since early 2008. And as soon as there's any lack of interest rate cutting or lack of decent economic growth, you tend to go back into real and sometimes nominal house price decline, which seems where we're headed at the moment.
I asked Abdul Davids a little earlier where we were chatting about the PMI index and the implications of a potential 50 basis point rate cut on the manufacturing sector. Same question to you. What impact do you see a potential 50 basis point cut having on the property market?
50 basis points, not a heck of a lot at the moment. You'd need probably a few more than that. At the moment, a lot of the household sector has burnt its fingers. If you look at our estate agent survey, almost a quarter downscaling due to financial pressure. So there's a lot of balance sheet rebuilding going along, and what they call deleveraging. You've seen the declining household debt to disposable income ratio and slowing growth actually at the moment in household sector credit. I don't think because of banks tightening up. I think it's a combination of a relatively conservative banking sector, but a relatively cautious household sector too. So I don't think you're going to get a huge response from interest rate cutting, not from one 50 basis point cut. You would need a series of interest rate cuts to significantly low levels to make a noticeable impact on the housing market at this stage.
Where you touch on a household becoming a little bit more cautious there and possibly a little bit more realistic, to what extent are sellers becoming a little bit more realistic in their asking prices? Because we know that has been a problem in the past, where we've seen these extreme, asking prices in the market and just no demand out there or appetite for what's been asked for.
I think over the past few years, sellers have gradually been becoming more realistic, but they're not quite there yet. There's still almost 90% of them having to ultimately drop their asking price. That's very different to the boom years where it was down to about 30%. And the average time on the market is still up not far from 4 months, which is a bit long. In a healthy market, you'd expect to see it down around about 2 months. So we're not there yet. I think over time the realities do dawn, but I think still a way to go. This is just a period of very mediocre demand at best.
How long is it expected to persist for? I mean, what's your outlook as we wrap this quarter?
I think we're going to bump along the bottom. And when I say that, in and out of low house price inflation versus a bit of deflation for probably a couple of years. I would say till at least after the next interest rate hiking cycle, the next time interest rates get cut in, which could be a good few years from now. I think only then would you see a market that performs substantially better. The reason really being, well, firstly, I don't expect any fireworks in the global and local economy for a while. But it's still an unbalanced market. All the various oversuppliers have to be mopped up first. before the housing market can respond more significantly to any stimulus measures such as rate cutting or a decent economic performance. At the moment, it's just too unbalanced for that.
Too unbalanced, but what is certainly interesting is that house prices in real terms have declined, yes, cumulatively, 15.3% to August 2011.
Right.
But since July 2000, when this index specifically started, prices are still up 64.7%. So not necessarily all doom and gloom that's out there.
No, I think people need to understand housing cycles. The big cycle, you get these little bits of noise in between these short cycles, but the big housing cycle is on average about 15 to 20 years long.
Yeah.
So you get these booms periodically, and they are quite extreme booms, as we had. And then you get long periods of stagnation which persist until the household balance sheets have been rebuilt, until all the excesses have been eliminated, be it with the household sector's finances, be it with oversupplies that have been built by the development sector. And it takes a long time. There's no easy way out of it. So I think people just need to understand that there's this big property cycle, 15, 20 years on average, and it's really a slow process.
Well, John, let's leave it there. Thanks so much for your time today. Of course, John Loos is a property market strategist at FNB and running us through FNB's latest house price index that was released earlier today.